Howdy everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company LendingClub. This was actually brought up by the commenter SSJJ005, where he pretty much just said, could you do a review on the company LC, which is again LendingClub. Now just looking as of course just their name and their website, they pretty much essentially lend money to people, right? So let's actually analyze this company based on their fundamentals and see if maybe we would actually like to buy them today. So with that said, let's get started with this analysis. Alright guys, we're gonna come here into the calculator. We got the ticker symbol of LC, market cap of $1.5 billion. So it's a really tiny company in comparison to the ones that we have seen recently, right? PE of 5.68. So based off of this PE and the current share price of $14.89, this is telling me that this actually might be a pretty decent price to buy at today. However, guys, let me just point out something that will probably shock all of you, and that is that if we take a look at their share price graph within the past year or so, we could see that this company has just been up for a ride, right? As of November 1st, 2021, they reached a peak, guys, of $47.87. That is absolutely massive. And again, as I just said, we are currently at $14 or so. And if we actually take a look at back even further, we can see that they essentially benefited from the hype of the 2021-2020 bull market run that just made all stocks skyrocketed. This is another example as to how you can overpay for growth, because if we would have analyzed this company around this point, I would have probably said that it is overpriced based on their fundamentals and that the company should be worth less, and a lot of people would have been like, no, that's not true. And currently, guys, they're at $14.89. So that is just one example as to how you can 100% overpay for growth, and that you do not just want to buy a company just because it's going up in price. As it currently stands with a 5.68 PE, this might actually be not a bad price. Now, when it comes to their dividends, they don't have any, which means that all of their cash flow is going straight into themselves to grow the company. Now analyzing some fundamentals, starting of course with the net income 5 years ago of negative $153.8 million to today, guys, of $18.6 million. Increase of 112%. While this is good though, look at just this graph, guys. 5 years ago, 4 years ago, 3 years ago, and 2 years ago, they were all in the red. Now, obviously 2 years ago is explainable because of COVID, right? But that does not necessarily justify the 5, 4, and 3 year ago number, even though this was increasing. Unfortunately, because we have several negative numbers and only one positive, even though if you take a look at this trajectory, you can tell that they may have continued the positive 2 years ago if COVID would have never happened. But nonetheless, guys, because they do have negatives, I have to give this a fairly low score at around the 30%, mainly because of the fact that, again, negatives, but it's not too bad because it is showing the trajectory that it was going to go up aside from COVID. Now looking at the free cash flow, the most important of all the profit metrics, because this is the one that companies use to essentially do everything. Now they don't pay out a dividend, but they could use their cash flow to buy back shares or pay down their debts, right? And just overall grow the company. So it's very important, guys, for this thing to be positive and of course to be increasing. Now, 5 years ago, they were at negative $618 million. And then 1 year ago, they were at $205.5 million. There is an increase of 133%, with a 5-year average free cash flow of $208 million in the red, so negative $208 million. Now, as it stands, guys, sure, this is looking fairly, I guess, bad, right? Because they did have 3 years of negative cash flow, which is not good at all. And then when COVID hit, probably their capital expenditures went down, which is probably why the free cash flow skyrocketed to $387 million. And then 1 year ago, guys, they came back down to earth to $205 million. This is all over the place, guys. This is not consistent at all. I don't necessarily know if they'll be able to do this again, but seeing that we are in a high interest rate environment, they may actually benefit from interest rates being this high for all we know, right? But overall, I'm actually going to give this another fairly low score of around like a 35% or so, just because of the fact that we are in a high interest rate environment and they may benefit from this, but it's still not that good at all. And now looking, guys, at the revenue we got 5 years ago of $1.1 billion to 1 year ago, guys, of $892.5 million. That is a massive decrease, guys, of 22.09%. And as you can see right here, they've been decreasing even from 5 years ago. COVID sure was a hit where they actually went down to $462 million from the previous year of $1 billion. But as you can see from 1 year ago, they did go down even still, right? Even lower than that what they did 3 years ago. So this is no good at all, guys. You want a company to have positive revenue, not negative. So overall, I'm gonna have to give this an even lower score of around 20% or so. Now analyzing some balance sheet numbers, we got the assets minus the total liabilities. We do this because we want to see if the company is able to survive a recession. Obviously, we are in a technical recession right now, right? As it stands, 2 consecutive quarters of negative GDP is a recession. So seeing that this company is in the business of lending, well, if nobody wants to take on money, nobody wants to take on loans, that means that they'll probably go under, assuming that this value isn't in the positive. And as it currently stands, guys, currently they're at $1.1 billion in the positive, which is good. And within the past 5 years, they've been in the positive as well, and the trajectory does seem to be going up. However, it's been pretty much flat overall. They did go down in this difference 2 years ago because of, again, COVID. And then 1 year ago, they did go up a little bit, but it wasn't above the 4 year ago and 3 year ago number. So the fact that they are today at 1.1 billion, I don't necessarily know where this is going in the future, but as it stands, guys, this is looking okay, I guess you could say. Average total assets, we get around $4.1 billion. Average liabilities, we get around $3.2 billion. And doing this difference, we get $892 million. Overall, guys, I'm gonna have to give this grade at around like a 60%. Just because it is in the positive, sure, but the fact that people may actually not take on any more loans as it comes in the future is definitely something to take into account. But just because the assets minus liabilities is good doesn't necessarily mean that the cash flow minus liabilities is good, right? As I said, cash flow, it is what companies use to pay down their debts. So let's do the exact same math, take the cash flow year over year and the liabilities year over year and essentially subtract them both. And normally what I find with this value, guys, is that, well, they all seem to be in the red. However, what I like to look for is the company's cash flow and liabilities increasing to the point that they're getting closer and closer to zero in a difference. And well, as it stands, I don't necessarily know where to put this because currently they're at negative $3.8 billion. However, if we take a look at the 5, 4, 3, and 2 year ago, well, this was actually getting closer and closer to zero, which is actually really, really good. And 2 years ago, guys, they were at negative $752 million. That is up from 5 years ago of negative $4.3 billion. So it's actually fairly good. The fact that today we're at negative 3.8, I don't necessarily know what caused this, but overall, guys, that's actually okay, I guess you could say. They do have precedent for it. We shall see if this is an outlier year. If we take the average cash flow and then subtract the average liabilities, we get around negative $3 billion. Overall, guys, I actually have to give this a 65% or so, maybe even like a 63% or so, mainly because, again, they were pretty steadily reducing this difference back to zero. However, 1 year ago, they did just go very deep in the red. Now let's take a look at the metric that companies usually tend to fail, especially small companies like these and companies that don't necessarily pay out a dividend, which this one also falls into that category. We got the shares outstanding, guys. This is a metric that companies, as I said, tend to fail because, well, companies just tend to issue shares without telling anybody, and it really does fall onto you to look at this value. And you want this value to be going down, not increasing, because of the fact that the more that they issue shares, the more dispersion of their cash flow that the company now has to provide for everybody else. If a company has 10 shares outstanding and you own 5 out of those shares, well, you own half the company, right? 5 out of 10 shares. But now if the company issues 10 more shares, now you own 5 out of 20 shares. That right there reduced your ownership by a significant amount. So very important for this thing to be decreasing, and unfortunately, LC, it is not. 5 years ago of 83.5 million shares to today, guys, of 103.6 million shares. That is a decrease in the 5 year of almost 25% at 24.07%. And from the previous year to the current year, this is another increase of more than 2.5%. So this is actually not good at all, guys, right? They are completely diluting you as the investor. And unfortunately, I do have to give this, guys, a really low score because this is consistently being diluted pretty much year over year. And I'm gonna give it, guys, a really low score of around 15% or so. And now lastly, looking at the cash and equivalents, they currently hold around $1 billion in cash and equivalents with an average cash of $545 million. Alright guys, now let's do a quick recap on all of the fundamentals. We got the net income at 30%, free cash flow 35%, revenue 20%, assets minus liabilities 60%, cash flow minus liability 63%, and the shares outstanding at 15%. This gives it guys an overall score of 33%, which is really low. Yeah, the fundamentals are just not that good guys for this company, unfortunately, but that doesn't mean that we don't buy it at this current point. Let's check out the discounted free cash flow. And now let's come over here and make some assumptions, low, median, high, using 3 different factors as always: revenue growth, the projected share buyback, and the required rate of return, which I like to keep flat at 10%. Now, for the revenue growth guys, let's come over here to Seeking Alpha's growth tab, and we can see that the revenue growth forward is 62%, and the revenue growth year over year is almost 110%. I do not believe that this is likely at all. That is massive amount in revenue growth, and from what we just saw guys, their revenue growth has been down year over year within the past 5 years. So I don't necessarily think that this will continue to happen. So I think that maybe at around like a 5% revenue growth for the low assumption, let's just say 7% for the median assumption, and at around 9% for the high assumption is a fair enough valuation for their revenue growth. Now guys, looking at their projected share buyback, we have seen that within the past 5 years, they have consistently increased this amount of shares outstanding. So I don't think that they'll be buying back shares anytime soon, honestly. Now, in that case, do I think that they'll do 24% again in the next 4 years? Probably not, but let's actually bring this to around negative 20%. Basically, the negative just means that they are issuing shares, right? So they're going to be issuing shares at 20% within the next 4 years. Let's bring this down to negative 18 for the median assumption, and down again, or up I guess you could say, to negative 16 for the highest assumption. Now with that, we do get some target share prices guys. For the target share price low assumption, we get $19.16. For the median assumption, we get $20.91. And for the highest assumption, we get $22.80. And now let's actually adjust for debt. The way we do this is we take the cash equivalents, we add the net debt, and if they have more debt than cash, then obviously this number comes down. If they have more cash than debt, then this number comes up. And as you can see, it does come up a significant amount now to $46.62 for the low assumption. For the median assumption, it is $50.27. And for the highest assumption, it is $54.21. Now adding a margin of safety of 5, 10, and 15%. To each one of these assumptions, we get $39.62 to $44.28. For the median assumption, we got $42.73 to $47.76. And for the highest assumption, we get $46.08 to $51.50. Guys, the current share price is $14.89. So what this is pretty much just telling me is that not adjusting for debt, guys, this is actually looking not too shabby either. Now, if we do adjust for debt, we are essentially around the ballpark that they were at the highest peak in 2021, right? At around like the $44 mark. So it really just depends as to what you believe this company will grow in the future. Obviously, the fact that we are under pretty much every single one of these, does this mean that you should buy it? Well, yes and no, right? If you believe my assumptions, then that's really up to you. However, I don't encourage anybody to do so because every investment is the present value of all future cash flow, as well as this is not financial advice. So for those 2 reasons, I have this calculator, guys, available for free. Anybody could have it, and you guys should use it to make your own assumptions, right? It's in my calculators playlist. There is videos there called discounted free cash flow, update and not update. It doesn't really matter which one you go to. There is a link in the description that leads you to the spreadsheet, and then at the spreadsheet you could pretty much come up here to file, make a copy, and then you could have this calculator as well as my book value ratio calculator for companies like banks, insurances, utilities, etc., re-evaluation calculator for REITs, and a dividend tracking sheet, guys, all for free. All I'm asking for in return is just like, subscribe, comment. It really does help here with the algorithm on YouTube. We have made the milestone of 800 subscribers. Oh Lord, I honestly, I just cannot believe it. Thank you all so much for everybody for helping me in this journey. You have no idea. I cannot believe so many of you. I just cannot believe it. It's just, yeah. I just cannot believe it. We're 200 away, guys, from 1,000 subscribers, and at 1,000 I do plan on making a very special video, so be on the lookout for that. The faster we get there, the faster I do it. Hopefully we can get there before the end of the year. That would be awesome. So thank you all so much for subscribing. Thank you all so much for helping me out. Again, for all those of you who haven't, it is free. I'm giving you guys free things. All I'm asking is for something free in return. So thank you all so much. And I really do appreciate every single one of you. Overall, guys, when it comes to LC, this is a company that, well, it's not really that impressive for me, right? Sure, does it have potential that the discounted free cash was telling me that it is a pretty good buy right now? Sure, but the fundamentals overall just aren't really that impressive for me. So based off of that, I really don't like this company. It doesn't really interest me, but don't let my opinion dissuade you from investing in this company. That pretty much does it for this video. Like if you like, comment, subscribe. As I said, you guys can follow me on my new tech sites. Link in the description below. So with that said, peace out and be on the lookout for the next stock analysis video.